Now, let's talk about what the latest downgrade means for the U.S. with Professor Oh Joon-seok this morning. Welcome to the program.
Morning.
So, Fitch Ratings on Tuesday downgraded the U.S. credit rating from its previous TripleA score to AA+. Now, the reasons they cited were fiscal deterioration, a growing debt burden, and governance erosion. Now, are these valid reasons? What's your take on this?
Considering financial vulnerability, mainly caused by increasing debt burden of the household and project financing construction areas, I could say it could make sense in a way. It is a confirmation of warning sign based on a possibility in the financial market risks. You have to pay more and more mortgages fees out of fixed salaries, and think about it, higher interest rate implies higher discount rate, which means decreasing the project value. When the project value decreased, which is collateralized as a credit, a project loan might be redeemed when certain conditions came to meet. As a result, a project might be in a default position. This is why the financial market turns out to be volatile. In this end, increasing debt burden came from consecutive interest rate hikes, which is unavoidable in a way to curb down the inflation. This might be not only the case of the United States, but also most of countries, including Korea, have to be prepared for the risk insulation due to monetary expansion based upon the prolonged COVID-19 pandemic.
Sure, the latest downgrade can be seen as rather a warning sign, right?
Mm-hmm.
Then the U.S. Treasury Secretary Janet Yellen she disagreed with the latest decision. Now, Professor, what's your take on the latest downgrade then? Is it fair?
We have to think about the position of the Fitch IBCA and the Janet Yellen's position. When it comes to the downgrade decision of the Fitch, it might be a warning sign of the financial market under the worst case scenario. As a credit agency, it is the writing, and Fitch analyzed the outlook of the possible financial risks, and they did the credit changes. That is the right decision, I say. But when you see the market and drivers of the economic growth, future of the economic trend, there are normal scenarios and best scenarios as well. That is Janet Yellen's position. In this sense, I could understand Janet Yellen's remark, and also I agree on her conviction on the economic prospect in the United States with a broader view of the economic cycle. That is because the Fed has done, comparatively speaking, up till now, Fed has the right measures at the right timing in a way to sustain the job position and market cycle during the COVID-19. While controlling the inflationary pressure and not to be messed up with political populism, in this respect, I could vote for Janet Yellen's opinion, and I do believe a risk controllability and policy decision mechanism of the U.S.
Sure, the comments do sound fair from both of the sides. Now, let's turn to our attention to the economic situations here in South Korea. The country's trade balance was in the black for the second straight month last month, July, on the back of rising auto exports and also falling raw material prices. Are they really good signs, Professor Oh?
We hope so, but trade trends are changing slowly, but it's just taking a breather. Korea lowered the trade surplus in July, and strong car sales and a drop in oil prices. The challenge is tough, however, and not over yet, because it's a contractionary surplus, not expansionary. I mean, a surplus comes from drops, not expansion of the trade volumes. Import drops by 25.4%, much more than export drop of 16.5%. What makes import drops, simply speaking, in two respects. As for Korean economy, more than half of imports are raw material and energy, simply speaking. You can imagine monsoon and vacation season in July and August. Manufacturing companies and distribution channels had to lower the level of inventory and facilitate operation in advance. And gas import dropped to 51%, followed by crude oil drop of 46%, and even coal plunged by 46% on year. On the other respect, deflating global market has been surrounded by predictable unpredictability, U.S.-China trade tension, not to mention a prolonged Russian-Ukraine crisis, negative signs on chip export dwindled by 34%. Export for petroleum products were down 42%, petrochemical by 25%, and steel by 10% on year. There are recovering signs as well. Car exports jumped to 15%. Export of general machinery also up 3%, and home appliance by 2.5%. From the global market perspective, this depletion of chip inventory and increasing shipments are optimistic sign for trade. But there are miles to go before we got solution how contractionary surplus should be changed into the expansionary surplus.
Sure, lots of global uncertainties making the outlook a bit hazy still at the moment. Now, we all know China is South Korea's top trading partner, but shipments to China also fell over 25% on year to nearly $10 billion. Now, what's holding back the shipments to China still?
Yes, you got the right point. It's worrying. Korean export is struggling to get out of the bumpy and muddy roads, especially a weak chip sector. A fall in petroleum product and petrochemicals attribute to the weak export, but semiconductor, that is the most bone of contention. Country's key export items sank 28% on falling demand and a drop in chip prices. Trade war between China and the U.S. drove chip supply chain into the bottom, which make the Korea in trouble. Biden administration has set export control on some of their products to restrict China's ability to make cutting-edge chips. Three big U.S. makers of chip machinery, KLA, Lam, and Applied Materials, are facing headwind in China also. Recently, though it might be a wish list, Korea's SK Hynix, the world's second biggest memory chip maker, said in an outlook, it shows early sign of chip sector beginning to recover from a deep downturn amid robust demand for artificial intelligence capacity, with rising interest in OpenAI's ChatGPT, seen as the main drivers of the demand. Check neutral and professional report. According to Gartner forecast, global semiconductor revenue is projected to fall 11 points this year, but the industry remain optimistic starting from next year that sales will bounce back in the longer term. Chip makers such as Intel Corporation are projecting that the market will double to $1 trillion in annual sales by 2030.
All right, to Professor Oh Joon-seok, thank you so much for a thorough analysis this morning. We appreciate it.
Thank you for having me.